that does appear as though it's going to happen. So one thing that I want to just walk through, this is a very overly simplified, but it illustrates an important point. And when we talk about year-end tax planning, there's two concepts to make sure that we're just clear. And so with that in mind, we have the adjusted gross income, which is basically all of your income added up. It's the last line on your 1040 form on page 1, so at the very bottom. And that relates to a lot of things that we talk about in tax planning. But then also taxable income also is another important number that we like to look at and focus on. And so the difference between those two is we just, overly simplified again, but to illustrate the point, we have the adjusted gross income at the bottom of page 1. You subtract out your standard or itemized deduction, you get your personal exemptions, and then you have your taxable income. So right now, this year, for 2012, this is what our taxable income table looks like. And this is where the tax is applied to. So I'm not going to go through the detail. I promise I won't get into too much detail. But in essence, what we do when we're planning is we'll look at, okay, how's the client filing? And then where do they fall in these tax brackets? And that gives us some information, and it's important information for us to look at, and I'll touch on it later. One thing I wanted to do is I wanted to take a moment and do a comparison for the tax rates. So if we go over the fiscal cliff and tax rates revert to the 2001 level compared with where they are now, what we're looking at is on the right-hand side here, somebody who has taxable income of $200,000. They're going to pay, in essence, $53,000. Let's see. In this year, they would pay $43,000, nearly $44,000 in federal tax, and have an effective tax rate of about 22%. This time next year, if the tax tables reverted, this is what they'd be looking at: $53,000 and change, and an effective tax rate of 27%. Oh, too fast. Same idea of comparison. This is for a taxable income of $100,000. You can see the difference in how it affects the total tax paid and the margin and the effective tax rate. Okay, so the couple points to keep in mind as we're going through year-end tax planning. So the Obamacare tax impact, for those with the AGI of $250,000 or more, that's for married filing joint. It's $200,000 for single filers. On net investment income, there's going to be a 3.8% tax. And then for wages on individuals with $200,000 adjusted gross income, or for married filing joint with adjusted gross income of $250,000, there's going to be 0.9. So related to that, capital gains rates are scheduled to increase. You can see in 2012, we have a 15% capital gains rate, and of course that's a long-term capital gains rate, and there's a lot of talk that can go there, but I won't get into too many details unless somebody has questions. But in 2013, that's scheduled to go up to 20%, and then of course if you're one of those high-income investors, you're looking at the additional 3.8%. I apologize for the poor quality on this, but there's some just important points to note. We don't need to pay attention to the numbers, although we pay attention to the numbers. You don't need to for the sake of this webinar today. But the education planning. So the thing I'd like to point out here is that there are education credits and deductions that are available. However, they are adjusted gross income related, and they phase out for the higher income earners. Long-term care premiums, we talk a lot about the need for a long-term care plan, which sometimes can include insurance. and those premiums can be deductible. It's age related, and it's not necessarily, there's no income relation to whether they're deductible or not, but that's a piece of information. Health savings accounts, not income related, rather if you have one of these types of accounts along with a high limit, high deductible medical plan, we like to use these. These are great year-end tax planning tools. An important point to note is for our clients who are in the age range of 65 and above, subject to Medicare, we want to make sure that we keep in mind what the premiums are. The premiums are affected by your income. It's by a modified adjusted gross income, which is a big complex number, but it's definitely something that we take into consideration when we're going through our planning. Of course, we have our individual retirement accounts, or IRAs. Those, the important point to note here is that income limits do affect whether you can make a contribution to some sort of a Roth. Some sort of an IRA. There's three types of Roths that we like to talk about. The traditional one, which is you put the money in, you get a tax deduction, and then the money grows tax deferred until you take it out of the account. And then when you do take it out of the account, you have to pay tax on it. And you have to qualify in order to have a tax deductible contribution. Roth is basically the opposite in that you put the money in this year, you don't get a tax deduction, and then the tax and the account grows tax-free, and you never have to pay tax again when you take the money out of the account. A non-deductible, you can see here that there are no income limits. Anybody can put the money in there, and it's a hybrid of these two, the traditional and the Roth. So, just basically stated, what happens is you put the money in a non-deductible, you don't get a tax benefit, but that money gets to grow tax-free. Not tax-free, tax-deferred. So when you now you have an IRA with basis, which means that part of, when you take the money out, you get to take part of it out, the part that's related to the original contribution you made, comes out tax-free, and then the earnings or appreciation, that part is subject to tax. Last point I'll make on this slide is that a Roth conversion, there is no tax, there is no income tax requirement related to being able to do a conversion. So this year, we're in a bit of the bizarro world, simply because of the fiscal cliff. Going back to the table where we had the likely scenarios and what we think is going to happen, Jim mentioned that we usually shy away terribly at making any kind of prediction or using our crystal ball in any way, shape, or form about the future and what lies ahead. However, this year, with regard to tax planning, we're willing to make a little bit more of a projection than we otherwise normally are. And we think that it's very likely that those who earn higher than $250,000 are likely going to face higher taxes next year, and those under are likely going to be not affected to the same extent.